Do you want to invest but feel like you don't have time to analyze charts or study the market? What if there was a simple, automated portfolio that grows in the long term without requiring you to monitor it every day? The truth is that many young professionals want their money to work for them but end up postponing it because they think investing is too much work. If that sounds like you, stay until the end because I'm going to show you the perfect ETF portfolio for those who want practicality and quick results. In this video, you will learn how to build a portfolio that adjusts itself, takes advantage of market growth, and requires minimal effort on your part. Forget the complications. This strategy works even for those who have never invested before. So, if you want to start now and secure a solid financial future, let's get straight to the point. And while you're here, don't forget to like this video and subscribe to the channel because that helps me keep bringing content that will transform your financial life. Many people think investing is complicated. Maybe you've tried picking stocks, following trends, or even joining investor groups to look for recommendations. But the problem is that this approach takes time and dedication, something most people don't have. And the worst part? Most investors who try to beat the market end up losing money in the long run. Yes, even financial market professionals, who spend all day analyzing companies, often fail to outperform a well-diversified ETF portfolio. And do you know what that means? That the best strategy for those who have little time is not to guess which stocks will rise, but rather to build a smart portfolio that works for you automatically. So, what exactly are ETFs, and why are they perfect for those who want to invest without complications? ETFs, or exchange-traded funds, are funds that replicate the performance of a set of assets, such as stocks, bonds, or commodities. By buying an ETF, you are automatically investing in dozens or even hundreds of companies at once. This provides instant diversification and reduces risks without requiring you to select individual stocks. And the best part? They have very low fees, are easy to buy, and can be used to create a balanced and efficient portfolio. Now, if you're enjoying this explanation so far, hit the like button because that helps the channel grow and reach more people who want to learn how to invest safely. Now let's get to what really matters: the perfect portfolio for those who have little time and want quick results. And the best part is that it consists of just 3 ETFs that, together, form a balanced and efficient portfolio. The first ETF you need to have is a global stock ETF, such as IVV or VOO, which track the S&P 500. This type of ETF gives you exposure to the 500 largest companies in the United States, ensuring solid long-term growth. The second essential ETF is a fixed-income ETF, such as BND or AGG. It serves to bring stability to your portfolio and protect your wealth during times of crisis. And finally, we have an extra diversification ETF, which could be in commodities or real estate. If you want inflation protection, a gold ETF like GLD can be a good option. If you prefer passive income, you can choose a real estate investment trust ETF, such as VNQ. And now that you know the ideal ETFs for a balanced portfolio, I'm going to show you how to set up this portfolio in less than 10 minutes. First, you need to choose a reliable brokerage. There are several options in the market that offer ETFs with low fees and easy access. After creating your account and adding funds, simply search for the ETF codes we mentioned here and buy them in the desired proportion. A good initial strategy could be to allocate 60% of your capital to the stock ETF, 30% to the fixed income ETF, and 10% to the diversification ETF. And most importantly, for this strategy to work, you must continue investing regularly, making monthly contributions to grow your wealth over time. If this is making sense to you, comment below which of these ETFs you like the most and whether you already invest in any of them. Now that you know the basic structure of this efficient ETF portfolio, let's dive even deeper into the reasons why this strategy is so powerful. First, it's important to understand that the simplicity of this model doesn't mean a lack of sophistication. In fact, the world's largest investment funds use similar strategies because they ensure broad market exposure and reduce risks intelligently. When you invest in ETFs, you are automatically benefiting from the growth of the world's largest companies and sectors without having to worry about which specific stock to buy or sell. This eliminates the need to try predicting the market, something that even the most experienced investors struggle to do consistently. Another major benefit of ETFs is transparency. Unlike traditional funds, where the composition can change without prior notice, ETFs follow a specific index and allow you to know exactly where your money is invested at any time. Moreover, since they are traded on the stock exchange like stocks, they offer instant liquidity, meaning you can buy and sell whenever you want without waiting for the fund to redeem your investment. This flexibility makes ETFs an excellent option for those who want to maintain full control over their investments without needing deep financial market knowledge. And what about taxation? Many beginner investors worry about taxes on investments, but the truth is that ETFs can be very tax efficient. In several countries, there are ETFs structured to minimize tax impact, either through automatic reinvestment of dividends or specific tax advantages for index funds. This means that, in addition to simplicity and diversification, ETFs can help you optimize your net returns over time, ensuring that a larger portion of your profit stays in your pocket instead of going to tax payments. Another fundamental point that makes this strategy so powerful is automatic rebalancing. Many individual investors struggle with the temptation to constantly adjust their portfolios, buying and selling assets based on market sentiment. However, this practice can be harmful in the long run because decisions are often driven by emotions rather than a solid strategy. With a well-structured ETF portfolio, you avoid this trap because the funds themselves make internal adjustments as needed. This means your portfolio stays aligned with your original strategy without requiring you to spend time and energy monitoring every market movement. What if the market goes into crisis? This is one of the most common questions among new investors, and the answer lies in the smart diversification of ETFs. While some asset classes may experience sharp declines during times of uncertainty, others may appreciate or at least cushion the losses. For example, a portfolio that combines equity ETFs with fixed income ETFs can provide more stable performance, as when the stock market falls, fixed income securities tend to appreciate. This additional protection helps you stick to your strategy without panic, avoiding the temptation to sell at a loss. Another interesting aspect of ETFs is the possibility of investing globally without complication. By choosing international ETFs, you are not limited to the economic performance of your country. This is especially important for investors living in smaller or more volatile economies, as it allows you to take advantage of opportunities in both developed and emerging markets worldwide. This approach reduces concentration risk and increases your chances for long-term growth, ensuring your money is always positioned where there is the greatest potential for appreciation. And what about costs? ETFs are known for their low management fees, which means a larger portion of your return stays with you. Unlike actively managed funds, which charge high fees for management that often doesn't outperform the market, ETFs offer an affordable and efficient alternative. Over the long term, these fee differences can result in significant savings and a substantial increase in accumulated wealth. This is one of the reasons why the world's largest investors recommend ETFs as the backbone of a successful portfolio. Now, if you're wondering when the best time to start investing is, the answer is simple: now. The financial market will always have volatility and uncertainties, but what truly makes a difference in the long term is the time your money stays invested. The sooner you start, the more time you'll have to benefit from compound interest, which is the real engine of wealth growth. Don't wait for the perfect moment to invest because it never arrives. The ideal approach is to define a strategy, choose your ETFs, and begin investing regularly, regardless of market conditions. Additionally, one of the biggest mistakes investors make is trying to time the market, buying at lows and selling at highs. This is a dangerous game that often results in losses. A much more effective approach is regular investing, where you make constant contributions over time, regardless of market fluctuations. This strategy, known as dollar cost averaging, reduces the impact of volatility and ensures that you're always purchasing assets at an average balanced price. In the long run, this tends to generate superior results and eliminates the stress of trying to predict the future. Government changes always bring uncertainties to the financial market, but history shows that such moments also represent opportunities. The return of Donald Trump to the presidency of the United States may generate short-term volatility, but the fundamentals of the economy remain strong. Large companies will continue to innovate, the global market will keep growing, and ETFs remain one of the best ways to capture this growth. Regardless of the policies adopted, the United States remains the world's largest economy and one of the safest markets to invest in. Historically, Republican governments tend to favor pro-business policies, which could benefit sectors such as technology, energy, and industry. Investing now in ETFs that track these sectors could guarantee good long-term returns. The fear of a new government might paralyze many investors, but the diversification offered by ETFs helps reduce risks. By spreading your investments across different sectors and global markets, you protect yourself from specific political and economic variations, ensuring continued growth of your wealth. Trying to predict the impact of political changes on the market is an impossible task, even for experts. Therefore, the best approach is to maintain regular contributions and focus on the long term. Time in the market always beats market timing, and those who continue investing during periods of uncertainty usually reap the greatest rewards. While many are paralyzed by fear, smart investors see this moment as an opportunity to buy assets at attractive prices. The new government might bring challenges, but also new opportunities. Don't let fear prevent you from building a strong portfolio. Start now and take advantage of the growth that will come in the years ahead. Sarah Mitchell always dreamed of achieving financial independence, but her routine was exhausting. During the day, she worked full-time as an administrative assistant at a tech company, and at night, she attended business school, seeking a better future. Time was scarce, and bills were tight, but Sarah knew that to change her life, she needed to make smart decisions about her money. It was during a conversation with a coworker that Sarah first heard about investing in ETFs. Her coworker explained how these investments offered diversification, low costs, and required little time for management, something essential for her intense routine. Curious, Sarah began to study the subject in her free time, listening to podcasts on her way to work and watching educational videos during breaks between classes. Determined to start, she opened an account with an investment broker and began her journey with small amounts. Each month, she set aside part of her salary to invest in ETFs that tracked the US and global markets. Since her budget was tight, she adopted the strategy of regular contributions, known as dollar cost averaging, buying assets gradually and reducing the impact of market volatility. In the first few months, Sarah faced challenges. The market's volatility frightened her, and at times, she felt like selling her investments when she saw short-term declines. However, she stuck to her plan, reminding herself that she was investing for the long term. She avoided following daily market news and focused on her strategy of making regular contributions, regardless of the market's fluctuations. As time passed, Sarah began to see results. Her portfolio gradually grew, benefiting from compound interest and asset appreciation. After 2 years of investing, she realized that her disciplined strategy was paying off. Her ETFs had appreciated significantly, and her wealth was much greater than she had expected. Moreover, Sarah realized that her financial knowledge provided her with security and peace of mind. Even with unforeseen events, such as unexpected medical expenses or economic fluctuations, she knew that she had a growing reserve that could help her in the future. This confidence made her feel more motivated to continue her studies and seek new opportunities for professional growth. Upon graduating, Sarah received a promotion at work and increased her monthly contributions. With more money available, she began to further diversify her portfolio, including sector-specific ETFs that tracked promising industries such as technology and healthcare. Her commitment to investing became a habit, and her discipline was rewarded with continuous growth in her wealth. Today, Sarah is an inspiration to her colleagues and friends. She proves that, even with a challenging routine, it's possible to build wealth through intelligent and consistent investing. Her journey shows that the secret isn't in having large sums to invest, but in starting early, maintaining discipline, and trusting the power of the long term. With dedication and patience, anyone can achieve financial freedom. To wrap up, let's recap what we've learned today. We saw that trying to beat the market is a risky strategy that requires time, something most people don't have. That's why a simple, automated portfolio with ETFs is the best solution for anyone who wants to invest efficiently and securely. With just 3 ETFs, you can build a diversified portfolio that grows over time with minimal effort. And the best part is that anyone can start right now, without needing to study the financial market for hours. If you haven't started investing yet, now is the perfect time to take the first step. And to make sure you don't miss more content like this, subscribe to the channel now and activate the bell, because here, I always bring simple strategies for you to grow financially without complications. See you in the next video.